It should come as no surprise that a majority of American workers expect that Social Security benefits will have to be cut in the future. And we have the latest on this courtesy of the Cato Institute's recent survey. It says, new poll, most Americans expect Social Security benefit cuts. A third believe the program won't exist when they retire. It's a pretty somber report. So let's look at this and what the implications could be on the future of reverse mortgage lending. A new survey of 2,000 Americans from the Cato Institute in collaboration with YouGov found that 83% of Americans have a favorable view of the program of Social Security, but that support does span across party lines. 90% of Democrats and 82% of Republicans agree with that sentiment. And most American workers, 82%, expect that Social Security will be funding at least part of their income during retirement. Now, against this backdrop, this positive view of Social Security, there is a growing and persistent concern about the solvency of the program and its ability to continue paying benefits that are promised. Americans express deep concerns about the program's future. 7 in 10 expect Social Security benefit cuts, and nearly a third, 30%, believe the program will not even be there or exist when they retire. A majority, 58%, say that Social Security offers younger workers a worse deal than current retirees receive, and nearly two-thirds believe Congress has broken its promise to manage the program. Notably, Democrats, 60%, and Republicans, 55%, agree that younger workers are now getting a worse deal, and 58% of them in both groups believe that Congress has broken its promise. So let's talk about the far-reaching implications. For most American seniors and retirees, Social Security is the foundation of their retirement income. So if there were reductions in the future, that could be highly problematic, and it could push seniors to consider other sources of cash flow each month. But this is also something that we're seeing demographically because of the lower birth rate we have here in the U.S. and also throughout many Western developed countries. What you're seeing is that you have fewer active workers paying into retirement programs to support an ever-increasing retirement population. And mathematically, that is not possible. It's just mathematically not going to happen. So you're going to have a large issue. So this growing pessimism about Social Security has persisted for many generations. Of course, this began to actually crop up in the 80s, and it's actually accelerated. So because of this highlighted concern, Americans may need to rely on their assets beyond just their private retirement savings, such as 401ks, IRAs, or Roth. They're going to need to look at other assets to supplement their retirement income or cash flow. So that could mean selling different assets that they've invested in or equities, but it could also mean tapping into what is typically one's largest asset, that is their home. So tapping into home equity could make strategies like equity release a source of reliable retirement income and could be very helpful. But there is growing skepticism about the Social Security program, and part of the reason is that no politician, I don't care whether you're talking Democrat or Republican, wants to touch what they call the third rail of politics, which is Social Security benefits. So any proposed reduction by a political candidate is a sure recipe for sudden death, but we have to do something. But in the meantime, the concern is growing. And if this ever did come to pass, we would likely see a very marked increase in the demand for home equity and therefore reverse mortgages. This next story speaks to the future of reverse mortgage lending and also retirement-focused home equity solutions, which are becoming increasingly important in the retirement landscape. For this, we're going to look to a recent column from Housing Wire, and it's a major capital investment that has been made. Last week, Housing Wire reported that Blue Owl has committed $2.5 billion to Finance of America, and they're also investing $50 million in equity. And this capital infusion would help support Finance of America's push to build a full-spectrum home equity platform. The $2.5 billion investment would be earmarked to help Finance of America increase their home equity offerings, and also the investment of $50 million in equity to the reverse mortgage lender. And this is the latest in a string of Blue Owl moves or investments in the home equity space. So This is something that Blue Owl is seen as an emerging trend. And remember that these investment funds are looking to the future. They're not wanting to react to current trends. They're looking a little bit beyond the horizon. Finance of America CEO Graham Fleming called this a pivotal moment for the senior finance market, saying that the partnership with Blue Owl aims to build a platform of scale and innovation to better serve one of the fastest growing demographics in the United States. Finance of America estimates that more than 10,000 Americans reach retirement age each and every day, something we've mentioned here on this podcast and, of course, you've seen on the news wires. Ray Chan, Senior Marketing Director and co-head of the asset-based finance at Blue Owl, said that this partnership provides the capital, the strategic alignment, and the financial innovation engine to help build a category-defining products at scale. And like their peers, Finance of America has been leaning into the proprietary or private reverse mortgage marketplace, which has accounted for more than 35% of industry volume, and that's dollar volume, by the way, not the number of units, for the first 3 quarters of 2025. So what does this all mean? Well, first, it means that the mainstream capital markets are seeing the value and the future potential of equity release or reverse mortgage lending. And that's a very good plus for us. And for years, reverse mortgages were seen as a last resort, but financial reality has a way of encroaching on that viewpoint. In fact, many are now asset rich, but financially cash flow constrained and facing uncertainty. And we just mentioned the uncertainty about Social Security. So Blue Owl is actively saying home equity is going to play a larger role in retirement funding, and they're looking for platforms that can responsibly and efficiently deliver access to home equity to older homeowners. So should we see stability in the housing market? In other words, if home values remain relatively stable, then we can expect to see more innovation in hybrid products from reverse mortgage lenders, which we've covered here recently on HECMWorld. And speaking of scale, with $2.5 billion of committed capital, Finance of America really has some significant tailwinds that will help them in the development of new products. This could lead to more consolidation in our marketplace, but we'll be keeping you apprised of any changes. And we're back this week with our monthly installment of Reverse Market Insights Market Minute with John McHugh for all the latest trends in HECM endorsements and lending. So John, thanks again for joining us. What do you have for us this week?
Thanks, Shannon, for having me back. Again, really appreciate it. Unfortunately, I'm sounding like a broken record at this point, but with the shutdown that we had, HUD still hasn't been updating data. June is still kind of the last real concrete data that we've had. With that being said, we do have the higher level data that we've been reporting on and looking at, so we will continue to look at that data. I thought, we just kind of talk about the 10-year CMT. Unfortunately, from October, November, we have been seeing a slight increase. I mean, it hasn't been drastic, but it hasn't been going in the way we would like. But it's still considerably down from where the year began. So all in all, we're still in a much better place as far as the way that the year is ending up here. This is just to show, haven't got any endorsement number or application numbers, either since June. So we're kind of frozen as far as applications are concerned. And again, no endorsements in October. So, what we've done here is we're looking at we're assuming 2 months of data for November. So assuming that we're looking at October and November combined data, you can see that there is no October column here. So if we take the average over the course of October, November, we get an average of 1,953 loans. But it is possible there could still be a backlog from October. So if this is true, then, as far as the 1,953 average are concerned, then we'd say that this would be that there is a drop from September of 11.7%. Again, we're working with averages here, but if we're taking that average, essentially endorsements have declined since we got any last real good endorsements in September. This could even be a conservative estimate of things. Again, until we get better data, we're just making a lot of assumptions, but it just is what it is. Kind of the best that we can do. We have to work with the data that we have, right? So if we're using the same, average assumptions, Mid-Atlantic was up 7.6% to 156 loans. New England added 4.3% to 97 loans. Both of those regions are on the smaller side, and it's worth noting that all five of the smallest regions outperformed the top five, with New York, New Jersey almost managing a gain here. As far as the top 10 lenders are concerned, they kind of matched what the geographic performance was. Just two of the top 10 had rising endorsements. Fairway was up 9% to 79 loans. TMAC added 5.3% to 109 loans. But unlike the regions, the lenders were more mixed, as the two gainers ranked 4 and 6, while the nearest miss was Mutual Omaha, the largest originator in the last 12 months. So they just barely missed actually gaining anything. RMI, we have reached out to HUD to see if we can get an estimate of when they may be able to provide updated data, since the last time they updated the HECM snapshot report, which is again, that's the much more detailed report I mentioned earlier. It was last updated in June. We're still awaiting a response, but they're still digging out from the closure, so we'll see what happens there. What we do need to understand, though, is that both the 10-year Treasury has been rising, and we're also seeing that same trend with the 10-year CMT. So I wouldn't expect rates to be any saving graces for endorsements anytime soon. But with that said, our 2025 totals for we're looking at January through November, between 2024 and 2025, looking at those in comparison. Our 2025 totals have already surpassed that of what we saw in 2024 at this point, and we still have December numbers to report. So, at least from a year-over-year perspective, from an endorsement perspective for the HECM program, we are seeing some gains from that perspective, and that was certainly aided by the help with lower rates. So I find that encouraging, and these numbers only reflect the HECM program. So there's also plenty of proprietary loans being done that do not reflect in these numbers either. So all in all, I think we're in a pretty decent shape, but I think that obviously there's so much more work that we can do. So tune in next month, find out what happened in December as we wrap up the year, and I'm wishing everyone a wonderful holiday season, Happy New Year, and we will talk to you in the new year. Thank you.